All right, welcome to our wealth call for September 2024. I'm Nick Emerson, the host for our State of the Market call. And today we're going to be talking about what is the state of the San Diego County real estate market. As there's a lot of different things going on right now, as far as interest rate volatility, the presidential election coming up, obviously a lot of economic news to start to better understand where we're at and where we might be heading. So I'm excited to dive into this information as we're definitely seeing some changes in the market. We are seeing some softening. However, that's all relative to the light speed we've been traveling at the past 5 years in COVID through real estate. So without further ado, I'm going to get into the state of our market for detached and condo owners throughout the county of San Diego. All right, overview. We're going to talk about year-over-year trends. So looking at last year to this year, September over September. So we did some little real-time data for this September and also some August over August. So we're going to see really what's going on the past 12 months, but also what's been happening in a bigger picture, leading up to COVID all the way till now, which does help tell us a little bit of interesting insights that we wouldn't otherwise pick up in a one-year trend. We're going to talk more about the state of the market as far as what it would look like as a seller or a buyer, why you might be in the market as one or two of those options this fall or winter. And we're going to go over just kind of what our expectations are or my expectations are between now and the end of the year in our real estate market. So let's get started on our snapshot of trends. If you'll see here, we're going to focus on detached properties first. And I want to give you a quick snapshot of this market, and then we'll go dive into each new listings, active listings, pending sales, and kind of go through each category one by one. So as you'll see with the detached market, what we're seeing is new listings were up 28% from last September. So we have more supply available in the marketplace compared to last year. Also, active listings up 35% plus. So there's obviously more supply in the marketplace. But also what's interesting is there's more supply coming on at a time historically we see declining as we get into the fall and winter for normal seasonality trends. Pending sales or demand is actually up 30%, which is awesome, right? That means the market's picking up some of the extra supply. And a lot of that has to do with the interest rate cut, which we've saw rates soften probably 3 or 4 weeks prior to the Fed's announcement last week. So we're seeing the market respond to that. However, it's not responding in excess or up to the additional supply. So note that, right? Because that's going to impact our economics of supply and demand. If we have 35.4% more active listings on market, but we have a 30% more demand, well, we still have a 5.4% surplus of supply. So long as those numbers aren't equal or demand is exceeding it, we're going to continue to add more and more inventory, which is what we've been seeing throughout the course of this year. However, like I said, demand has picked up a portion of that. So that has kind of stabilized things, maybe not as volatile or dramatic as far as what we might see on some of the metrics or results from that. Next, we're going to see the median sold price. So we're looking at, for detached, we're up a little over 1.5% for the year. So we're coming back down to reality in some sense. And outside of that, sold listings, we have 906 sold here in 23. And to date for September, we're at 912. So we're actually up sold listings for this month compared to last year this time. But that's all relative to also having a lot more inventory in the marketplace than last year. Next, we're going to look at the condo attached market, which we're seeing mainly mirror that of detached, with a few exceptions that we want to be taking notes about, especially if you're in the condo market. For new listings, much of the same as far as demand is up. So if you go back, it's up 20% for condos, 28% for detached homes. active listings. So this one is, one of the bigger numbers or eye-popping trends. 70% more active listings on market compared to last September. So we're at 1,114, and today we're at 1,890. So a big jump. However, I want to remind people it's all relative in the sense that active listings before COVID, right, we're in the 9,000, 10,000 range. So it's more inventory relative to where we've been in 2023. It's not a tremendous amount of supply or inventory available across the market as a whole. Pending sales. So demand is up for condos, 21% from last year. So we've got a little over 120 plus more contracts currently pending. But again, what we want to pay most attention to is the 70% of active listings versus 21% increase in demand. So that's still a cutoff of 49%, meaning there's still 49% more active listings than demand being met. So in that case, naturally, we're going to see or continue to see an increase in the overall supply. And so long as demand's not meeting or exceeding it, naturally, that's going to typically lead towards a softening of those trends. So sold listings, or excuse me, median sold price rather, we're not seeing prices reflect or kind of show what the weakening demand might suggest here in the trends. But I believe we're just at the beginning of starting to see some of the softening in the form of our metrics. So we'll continue to pay attention to this month by month here to see if there's any dramatic shifts. But we are expecting to continue softening so long as this remains true with demand not meeting or exceeding supply. Sold listings. So actually we're down for the condos. We're down 10% compared to last year. So think about those two trends hand in hand here. We have inventory of new and active listings skyrocketing. At the same time, we have demand dropping. So in detached, we still have a positive figure with demand. So it's still exceeding what it was last year. But again, a 10% drop in condos. So the big portion of that or aspect about that that's important, again, is that you're seeing the demand drop off coupled with supply going way up. So under those conditions, if those were to continue, we might see some, significant drop off in price appreciation in that category. Now, the equalizer in our market is going to be interest rates. Naturally, they have softened already, but is the Fed going to conduct another round of interest rate cuts before the end of the year? And if so, is that enough to lure people off the fence to take away, step back from the wait and see approach and jump into the marketplace? In which case we could see demand pick back up. However, historically speaking, we're looking at a election year. We have seasonality, which is typically a trend every year. And then we have a lot of people that are kind of skeptical of what's going to happen next. So we have a lot of wait and see people as well. So that could ultimately help in the sense of rates improving with demand going up. However, that could also turn into a much more dramatic change in trends in the coming months. So let's take a closer look at each category to really see the comparison of what's going on here for a year-over-year standpoint for new listings. And this is going to be for both comparing detached and condo side by side. So we're up 28% in supply for detached properties for August over August, and condos up 20% in August. Now, note that the number of new listings hitting the market is higher in September. So know that for September 2024, the condo category, we're going to continue to see more new listings hitting the market at a higher clip in September. So this trend will continue as far as more supply as we head into October. And that's where we might see some things shift a little bit as more seasonality impact kind of weighs on the market. More people tend to take a step back as they get ready for the holidays to spend time with the family, friends, and really not in the proactive mode to go out and buy, sell, and make changes during this time period between now and the end of the year. So looking ahead to the 5-year. So this was an interesting one, right? This is where looking at a 5-year versus a 1-year, you start to get a better idea of what the cycles have looked like, right? So let's take a look at the trends here for the new listings. This is going to be a 5-year trend. So what's interesting here is let's note where we see the peaks of new listings and where we see them drop off per year, because that starts to leave clues and tell us what's normal or not normal relative to what's been going on the past few years. So if we're just making notes of where the peak is of new listings to hit the market, and as a reminder, detached is the blue line, condos are the orange line. So most of these are going to be very similar on the points, you'll see, which is interesting. That kind of reaffirms the data and the cycles. But again, detached, we had a high in 2019 in May for new listings. July for 2020. July for 2021. June for 2022. Then we have a huge drop down here. I mean, 2023 was a very tight market. A lot of the inventory was not there, and so it really compressed against all categories. That's going to serve as probably our low point. So moving forward, it's going to feel like there's more activity relative to where we were last year. But again, going back to the highs here and the where the inventory is, the new listings peaked here in 2024. However, what's interesting is this. We went down in June, but our inventory of new listings goes up in July and August. Now, there's no other year tracked here where we see new listings actually go up after summer or the most popular months for selling. So it's interesting to note here, right? As we continue to monitor this, if we have more new listings and the trend going up, that is a dramatic, market shift from the past 5 years, and that could suggest that we could see, right, even more softening than we might think if that continues. Now, keep in mind this is only 2 months of data, so obviously, as we get into October, the trends might show a drop off in supply, in which case the outcome might not be as dramatic. But again, very interesting to see how the new listings, normally in time period where we head into fall and they're typically going to decline, are going up. What does that say? Well, my take on it is that a lot of people are playing the market based on the interest rate conversation, right? What the Fed is doing and maybe the perceived emotion behind how buyers feel about the market and the overall demand in the marketplace. If we have headlines that are saying the rates are softening, prices are improving, naturally they assume that's conditions that would lead towards greater demand, more buyers in the marketplace, and therefore sellers want to take advantage of that, regardless of what time of year it is or that we're heading into the holidays. So as we go to our next category, we are going to look at active listings, and I'll go back to the slideshow here. All right, active listings. We're up 35% here for detached listings and 70% for condos. And again, that sounds eye-popping, like 70%. So for every 10 listings that hit the market, there's 17 that hit the market this year. That's impressive. Now, again, keep in mind it's all relative to the market as a whole. So as a whole, we're still low in active inventory from a historical standpoint. However, demand's not meeting this current active listing. So that's going to obviously show up in the form of price softening. And we'll see that here in the trends as the median sale price and average number of listings sold will influence that as they go down. So again, August to August, we're up 35%. Now let's look at the 5-year trend on this. So as we can see, there's something dramatic happened here, which some of you may recall was called COVID. and really took a lot of the supply out of the market, which has remained the case through its entirety to date. So we're looking at a almost 5 years now of a suppressed market relative to what it was before COVID occurred. Now, if we look at the active listing for 5 years, again, this is a good perspective from a 5 year because you see a bigger picture of what's happening and where we've been. Prior to COVID, look at the number of active listings, right? We had almost 10,000 detached, whereas right now we're hovering around 2,900. So we're still a third or even less, 25% of where we were before COVID. Condos, on the other hand, there's not as dramatic of a change as far as the peak here before COVID was 3,742. And actually today we're at 1947. But if you notice the difference between those two of them, condos are only about 30% off of where they were as far as active listings as a whole in the marketplace from before COVID, whereas detached is still about 70% plus off of where it was beforehand. So you would think in that environment that naturally it's going to cause detached homes to have a higher growth rate because there's just less of them available and there's still plenty of demand for them. Now, looking at our trends here, again, we had 1947 active in August. And again, we're going to see that trend continue to go up as we have already looked at the September trends. And as we saw, we have 1890, but as of today, for active listings and condos, we're exceeding that number. So that tells us inventory is still going up even as we head into September and turning the corner into October. So naturally, that's going to continue to be felt in the form of less competition, less offers, and a slight softening in what you might offer for the property, depending on how long it's been there. So looking at the pending listings or the demand, right? What is the market demand over the past year and over the past 5 years? Well, the good news is demand is up 30% August over August. So there's 30% more closings occurring or more buyers buying, putting contracts together for detached homes. And there's 21% additional demand or pending listings for condos as well. So good news is we are having a positive increase in demand from last year, but the perspective is that it's up because we were in a very, very suppressed year in 2023. So it wouldn't take much to be improving or increasing off the metrics when you're coming from a year that is historically one of the lowest on record as far as transactions go. So again, it looks positive at the face, but understand that this could change dramatically if demand were to soften and drop off of where it is now, and active listings were to continue to come on market at the same rate they are today. Looking at the pending listing for the 5 year. All right, here we are in August. So we have a total of 1336 were pending or went under contract in the month, and 702 for the condos and attached. So relatively speaking, we have demand kind of volatility, right? We saw from June to July, it stepped up. And what we're probably seeing here is some of that interest rate factor, right? Normally when you see demand start to soften in these summer months, that's typical as we head into the fall. And to validate this or look at this from a historical perspective, what we can do is just take a look at what did previous years do in the same time period. So for this year, we saw demand drop from May to June, go back up in July, and drop again in August for condos. But for detached, we are looking at a slight decline since May as far as pendings go, which makes a little more sense, but we are seeing it level off here. So we could see demand kind of remain consistent, and that could be the interest rate effect. It could offset seasonality and the election as far as people saying, look, it's a good time to buy, the payment makes sense. I'm not going to wait or wait and see what's going to happen with the election or try to time a even better rate. I'm going to get in now because there's not a lot of competition and there's more inventory there has been from our last search in 2023. So let's go take a look at the other previous months, and looking specifically in last year, we saw a peak in June as far as the demand goes, which gradually declined all the way through the end of the year. And we saw things pick back up and remain relatively elevated from last year. But again, we're seeing a decline here. The question is, will this flatline, or will we see what we typically see with seasonality, right? As we go through the months here, July, August peak, and then as you see heading into the rest of the year, you continue to see demand drop all the way through each month heading into holidays, to winter. So with that being said, that's the question we face here is, will demand continue to offset the increase in supply because of interest rates and payments continuing to improve from a monthly payment perspective? Or will activity as a whole, seasonality, prevail and see demand drop? In which case we can expect prices will continue to decline as we move through the rest of this year, October, November, and December. But again, looking at these trend lines, it's really interesting to see in general how the market performs from the first 6 to the last 6 months of the year, how seasonality plays a part. Because again, the demand is really consistently going up as we head into the spring and summer, and consistently going down as we get into the holidays. It's a very, very solid pattern. So it's interesting when you see that pattern is interrupted. So we'll see in October, really, if it is going to change the trajectory of where we might end up in prices and overall supply based on where this trend line heads next. Heading into sold properties. The sold median sale price year over year. We're looking at detached and condos again. And detached is up 1.6%. So sounds kind of boring compared to the past few years we've had where we're accustomed to seeing double digits. Right now we're seeing that obviously demand is softened and supply, as again, continues to go up. But also we're just at the very beginning of seeing some of these price appreciation and metrics start to maybe show what's been going on the past few months that may have otherwise been hidden by other low points from last year. As you compare year over year, as data gets smaller than last year, it's going to make numbers look bigger this year, or it's going to make them look smaller because prices were going up so high. So now we're looking at a flat line for condos and detached with a higher probability of being an even more dramatic decline as inventory continues to come on market at historically higher rates than years past. For the graph here for the median sale price for 5 years, let's go ahead and pull that up. And as you can see, in general, we've come a long way. January in 2019, detached median sale price, $610,000. And here we are today, fast forward, we recorded $1,050,000 in August. So 400,000, I'd say that's a pretty good clip of return, depending on where you've been the past 5 years. But also, look at the graphic here. It's good to see that it's an ongoing trend upward. However, we're starting to see market resistance with what could be, right, a stopping point, right? We've hit the top here in July, and we're dropping off. So again, these next 1 to 2 months, really 3 months, is starting to give us a sense of a real trend line that's forming in really a mature sense. But as it stands right now, what's saying is, yeah, prices have hit the top. The days of hitting record highs again are in the past. However, prices are still amazing from an ownership standpoint. So I've had a lot of clients that have expressed, desire to hold off on selling because they feel the market's less than ideal. Keep in mind, you're comparing that against one of the most impressive selling cycles we've ever seen in the history of real estate. So that perspective is important when you're looking at these bigger pictures here of where have we been and where are we right now relative to what we've had the past 5 years or even 10 years. We're still at phenomenal prices that are typically exceeding past years. So in that standpoint, if you're a seller and you're uncertain about whether now's the right time, I trust that this chart has helped give you confidence that you're still going to receive an amazing price. Even if we were to see things soften in the coming months by a few percentages, we're still talking about coming off of the highest historical prices ever recorded in the history of San Diego. I trust that you'll appreciate that. Looking ahead to the sold listings. So how many listings per category for detached or for condos occurred in any given month? Well, comparing August to August, we're seeing relatively flat for detached properties. So demand is roughly where it was last year. However, that's important to note though, because that's during a time period where inventory has been going up. So we would ideally, in order for prices to continue to grow or remain flat, you'd have to be seeing the sold listing count at a higher clip because it needs to be in pace and stride with the increase in the inventory as a whole available for sale. Now, what's interesting here is looking at the difference between condos and detached, right? We see a lot of similarities in the trends and the way they follow each other. However, we're starting to see some changes as far as the trends are not mirroring each other, actually going in opposite directions. Now, again, not significant if it's only in the form of a month or two. However, very significant if we're going to continue to see those trend lines mature and see more of a separation in demand for one product versus the other. So in this category, we're seeing condos are down 10% as far as the number sold from last August to this August. And that's coupled with seeing, right, 70% increase in active listings at the same time period. So would not be surprised to see listing counts continuing to decline. However, I'll be curious to see what interest rates do in the form of picking demand back up and potentially erasing any negative outpack as far as too much inventory and not enough buyers. Let's look at the 5-year for this trend to get a bigger perspective as far as the demand goes as a whole. We'll pull up the sold listings. So here in August, we had a total of 1,355 detached properties sold and 793 for condos and attached. Now, how does that rate versus other years? Well, if we're looking at sold listings in August, we're going to be heading to last year. Well, we're about roughly even across the board, not much change. Now, here's where you start to see the dramatic shift in sold listings is as you head into the years prior. We're talking about 1,613 detached properties, in the month of August, and 931 for the condos. So again, more demand is consumed units, right? We've seen more properties sell throughout the course of all the past 4 years, right? All these cycles are exceeding where we're currently at by a minimum of 1,000 properties or more. So it's interesting to see the demand, right? This is buyer demand sold listings. The demand is tapering off and it's gone up these past few months, given the time period of May, June, July. However, it hasn't gone up as much as you would think, considering interest rates are lower than they have been the past 2 years. So it's interesting to note that because maybe the interest rates are not going to have as big of an effect as we think as far as activity, demand, or how much it will make people get off the fence in general. I think we're coming from a time period where interest rates were so low, 2%, 3%, 4%, that our perspective may not be appropriate relative to the historical sense. And what I mean by that is a lot of buyers might be thinking in the standpoint that they're going to hold off until rates continue to improve. But again, they're comparing the rate relative to the lowest rates we've ever seen. So make sure you're keeping perspective of what you're thinking and why you're thinking it, and whether it's a valid thought from a bigger picture standpoint, because a lot of us tend to be very sensitive to information, comparing it to irregular time periods during COVID, right? So again, stating that we are very good at comparing the state of a market, whether we should or shouldn't do something based off of past years, which occurred during an irregular market due to COVID. So understand that and realize how important it is to have not only the now perspective, but also the bigger perspective, so that you might have a better idea of where we might be heading, or whether your decision making and how you're making it is appropriate in our current market. Okay, we're gonna head to what to expect as far as if you're a seller or buyer. Seller expectations for year end. Prepping your property for a sale is critical. It always has been. However, it's more important to be focusing on this as a listing agent for our clients, so they understand that presentation and preparation are more critical now than they have ever been in years past. You're not going to have 10 offers come in on your property. So it's important that you maximize those people that do show up to your property. Understand that we're coming from a place where you may have been accustomed to or heard of 30 or 40 showings occurring at a property. We're in a place now where the number of showings could be 3, 7, 10. So you can understand how you really want to take advantage and maximize the presentation for those showings, because every showing becomes that much more critical. Fortunately for sellers, it only takes one buyer to sell a property. So it's important you're taking advantage of how you're presenting your property and what you're doing to prepare it for the market, knowing we're currently in a place where there's more supply and buyers don't have to act right now. There's no immediate compelling call to action, knowing that rates are more likely to continue declining and inventory is going up. So naturally, you've got to have something that's super enticing, right? It's got to be something you really want, really motivated to buy, for people to be making a move right now. And again, that lends itself to making sure that preparing your property is important. If selling your property at the highest price possible and the least amount of time are your number 1 and 2 markers for accomplishing your sale and what you want to realize. Now, if you don't care about maximizing that and you're okay hanging out in the market for the holidays, then you don't need to prepare your property. But no, that's going to be the difference between eventually 30 days more on market or 30,000 less in your property. So it does matter, and it does make a difference if netting the most amount of money in the least amount of time is critical to your sale. The days of multiple offer scenarios are behind us. So don't expect after one weekend, in most cases, that you're going to be getting a handful of offers. So with that in mind, understand that we really need to dial back expectations of what we might see, how many offers we might get, and how long it might take to get those offers. Now, again, there's of course exceptions to this. Properties that are desirable, great shape, good location, present well. Some of those are obviously still selling within a matter of 1 week. However, the majority of properties currently on market are generally going to be on market for 30 to 60 days now, which sounds like a lot. Need I remind us, everyone, though, that an average stable balanced market in past years historically tend to be between 4 and 6 months for a sale. So understand we're still operating at a very high clip as far as the rate at which we sell properties, but it's not going to be the light speed that we're accustomed to from years past. Again, increased length of time to a contract. So instead of seeing an escrow open, first week, you could be looking at a month to 2 months, depending on the price strategy and how you're presenting the property, and that's okay. That's becoming the new normal, right? So understand from a owner perspective, if you have to have a conversation with your agent after 4 weeks on market, that's what's happening across many fronts right now. However, this is where skill, experience, and what we do for our sellers ultimately makes a huge difference in the outcome of the sale, even in a market not as in demand as others. You still can present, sell fast, and accomplish an amazing sale. And that matters who you hire and partner with to accomplish that. Lastly, interest rate factor. What's going to happen with interest rates? Well, we've already got the first half point cut from the Fed, which quite frankly was already built into the market about 45 days ago. In fact, rates have actually gone up the past 10 days or so since the Fed announced it because the market had already built it in so quickly ahead of time. So keep in mind on that is where rates are not softening any further at the moment. In fact, they're kind of stable since the market saw what it expected. The next question, though, is if the Fed has enough information and evidence to conduct another cut, and if so, how much will it really influence or impact interest rates? Again, if we're seeing rates head to the low fives, we're going to see at some point, right, demand is going to realize the opportunity in the form of more pending listings and less supply on the market if the case. However, if there's no other additional cuts and we're looking at a very similar, very kind of consistent interest rate around the low sixes, I wouldn't expect to see a whole lot of up or down as far as demand change goes from here on out. So again, if it doesn't have any other further interest rates, I'd expect prices to soften a little bit further than they would. However, if there is another rate drop, the emotional response in the form of buyers getting back into the market certainly has enough to change the trajectory of values and how much prices may soften between now and the end of the year. Buyer expectations, well, there's going to be more purchase options compared to last fall. But again, keep in mind, more options to choose from relative to a very, very suppressed market in 2023 as far as supply, demand, and overall transactions that occurred. So it'll be more, but it's not going to feel like you have a lot of options to choose from. So it still is going to be tight in the sense that you may have a couple more purchase options that weren't there last year, but there is still a lower amount as a whole. So basically be in the market and be looking, and you still need to be acting quick if the right property presents itself because we are still historically low in supply across the board. Now, there is still a greater likelihood now of negotiating a price lower than asking. However, keep in mind that's relative too, right? If an agent overprices a listing versus underprices a listing, that can have a dramatic impact on the metrics that have been taken from that. So case in point, if an agent just saw listed a property for $2,199,000, sold for 2.2. Well, the value was about 2.2. They just listed it aggressively to get a lot of action and get under contract in the first week. So no, those numbers can obviously be misleading depending on how it's priced relative to where the value might be for it. But understand that in most cases, if the property does not sell in the first couple of weeks, there's a greater likelihood it will continue to be on market. In that case, naturally, as a seller, if you don't have anything, you're more inclined to take something that is something lower than you're asking than nothing. So no, there is an opportunity for some deals out there. There are going to be people that do have to sell between now and the end of the year. And obviously, there are some signs in California that some of us are feeling the financials more than others. As I believe the credit bureau reported, 40 out of every 1,000 people are currently reporting or filing for foreclosure or bankruptcy in the state of California. So it's very possible we could see some deals out there in the form of people that have to sell and don't have time to wait to get the highest price possible. Now, buyer demand is still remaining steady, relatively speaking, but as we get into the holiday months, the question that we continue to ask ourselves is, how motivating is the interest rate factor? And will it be enough for buyers to be out in force in a time period that's normally quiet from a demand perspective? Also note that the election years historically tend to be years of less action. There's a lot more people that are taking the wait and see approach for whatever reason they may have. But know that at the end of the day, the immediate impact from an election is not something you'll see show up in the market in the short term. Typically, it's something that takes, in the form of 12 months or greater, in the form of policies and everything else that might come with it, outside of someone's just general emotion or excitement about someone winning versus not winning. Overall, you can feel good knowing that your monthly payment today is going to be less than it was in most cases over the past 24 months. So prices are a little bit lower than they have been, and interest rates obviously are lower than they have been the past 2 years. So for buyers, if you're in the market, feel good knowing that your monthly payment is going to look a lot better than it has for others, and you're going to have a little bit more supply to choose from. So if you're motivated, you're in the market, it's still a great time to buy because you can still get a rate around close to high 5% now. And you have properties that are out there that don't have multiple offers or a lot of competition. So there could be some benefits or concessions to be had. So know that you have to be in the market to know what's going on in order to take appropriate action. So if you're in the market as a buyer, you're curious, get yourself set up with an agent, get the feed going, and just start getting familiar with what the inventory is so that if an opportunity does present itself, you can jump in a time period where others might be waiting. Lastly, interest rate factor again. It's going to have a tremendous impact on the final outcome of our year. As if we do see another cut, there's obviously, of course, a higher likelihood that more buyers might be willing to jump into the market for those that have been waiting. So there's a lot of people out there that have been waiting many years, and this is probably your time right now to be taking advantage that you hadn't in past years. Lastly, year-end expectations. So I've spoke mainly about this, but in general, sale prices will be softening as a whole. Now, we're not talking about dramatic softening. However, we are talking about, 2, 3, 4% could easily occur. Condos, are leading the pack at the moment due to having, of course, more available on the marketplace. And we continue to see that to be the case through year's end. Now, whether that continues in 25 will yet to be seen. But know that if you're in the market as a condo buyer, there's a higher likelihood that you'll continue to see more options come up and more price reductions as we move through the rest of this year. All right, supply to ease market pressure on price. So typically, again, seasonality starts to show up this month and the coming months. So with that, if that are to be the case, where we should see supply start to come down, and so these dramatic, expectations of an increase during seasonality might not be the case. We might see a pullback as we do get into October, in which case we won't see as much dramatic softening in that instance. Now, I just want to state, of course, just the many variables going on: seasonality, interest rate movement, economic conditions, and a presidential election. All those things combined together, well, to me, that just means greater volatility. That means a higher likelihood of more dramatic outcomes on either direction because you have more pressing variables that are all influencing the market conditions. And so any one of those were to change things, well, if you add another one to it, it's only going to make it more dramatic in one direction or another. So could lead to greater volatility, but also know it also could lead to the opposite, right? If people look at this and they're talking about seasonality, they're uncertain about where the rates, how much they might soften, they're not sure where things might be next year, that could also lead to more valuables causing them to do nothing, right? Too much information typically leads to inaction, whereas clarity leads to action. So know from a perspective of seller or buyer, it's just important that you're talking to real estate professionals that are in the market today actively so that you can be preparing or at least maybe setting expectations for yourself for a sale or purchase in the next 3 to 6 months. All right. Looking forward to dropping some more stats, and we'll provide plenty of other information and data from this. And stay tuned for next month's call, where I'm going to be talking about 1031 exchange, tax tips and strategies. for selling and buying. What I mean by that is, how do you make sure you do a 1031 exchange, and in doing so, don't trap your personal money in the exchange, and also make sure your overall position looks better on paper when accomplishing the purchase. So a lot of little nuances that can lead to a much better outcome in the form of your position and your financial benefit when conducting a reinvestment using the 1031 exchange. Outside of that, I'm looking forward to hosting our 9th annual pie giveaway for Thanksgiving ahead, along with our food drive. Please be prepared to share, as we have a goal to exceed last year of over 2,000 pounds of food, and we're looking forward to your participation. Thank you, audience. I trust you found value from here, and I'll see you next month.